All right, welcome back to Trade and Wait. We're going to review price action on the S&P 500 E-mini futures chart, and it's the conclusion of a week. Today's Friday, 23rd. Monday, 26th is a holiday, so the market should be closed, at least for a portion of the day, right? U.S. markets are closed, right? So looks like this was a weekly draw, this volume imbalance on the ES. Price ran high of the week, previous week rather. Ran the previous week's high, traded down into this volume imbalance. The volume imbalance is between these two candles, this May 5th and May, May 5th and May 12th candles. This area here where there's no bodies, just wicks. That's the volume imbalance. Looks like price traded right down into it. If you had a strategy, in your strategy kind of just utilize the open and high low close of the previous week's candle, then you can see that it didn't run the previous week's low, but it traded into the previous week's opening price. So that's another thing to look at. And that's literally the top of this volume imbalance. So that's something we could observe as well, right? So let's do that. Let's look and see what the NQ's draw was. To erase. Oh well, we don't have to erase, but this is the weekly chart again. This is the bearish fair value gap, and you can see price here, it rated the previous week's high and essentially this stayed inside the previous week's range. All right, that doesn't, so there's that. It's actually holding above the pretty much half of this candle, but let's see what the what happened on the YM, similar situation to the NQ. Let's erase everything on here, and we have here liquidity void and a bearish fair value gap. Just group that up into one, and that was significant before because you see price traded right into, let's see how accurate or how close that was. 43,148 is the high of this candle here, the March 24th candle, and the low of this candle, February 24th weekly candle is 43,155. So didn't quite get all the way up there, but on a lower time frame, you can see here, so that would be this here, and you could essentially see that price stabbed above, traded back down, draw the opportunity, traded back up, pretty much stayed below consequent encroachment into there, then fell, retraced back into it, fell, traded back into it, consequent encroachment, fell again. But that's just for, it's not necessarily for trading purposes at this point. We're just doing weekly observation, right? So we have that volume imbalance here as well. Look, this volume imbalance here on the YM. Let's draw that out. I like to make that like a blue color. Dark though. Right, so we can see on this time frame and on this asset class, the YM, the E-mini Dow Jones futures, you can see that it rated the previous week's high and rated the previous week's low, and pretty much traded inside the previous 2 weeks candle. That's cool. What did the dollar do? What did the dollar do? This is a weekly chart again on the dollar. Weekly chart, we can see here automatically, we see a inverted bullish fair value gap and a bearish fair value gap. You don't have to utilize this at all. And you can just rely on this here. See that the bodies of the candle stayed inside of that range of this bearish fair value gap. Let's just look and see what it looks like. How the price react. I think that's pretty significant. No, that traded up into here and then held below the midpoint of this consequent encroachment of this candle here. But even with that, this is a balanced price range. This below this fair value gap, bearish fair value gap, and this bullish fair value gap. So let's see what that looks like, because investigating does not hurt, right? And we can see that price stayed below that level here. So if spotting this in real time, obviously this is a weekly candle, so this is a high time frame chart, and literally you would see this forming quicker because it's obviously it's like quicker but it's slower, right? Because the candles take longer to form, but you can see meaning aka the holding period of this type of trade is longer, so it's more, you're more apt to catch this trade than let's say a trade on the 1 minute with the same pattern. But anyway, let's see here. So here price may be going down here, but $1, which means that we can possibly expect higher prices, even though recently the dollar and the other asset classes have been trading. That's not even the ES. What's wrong? What's going on? Have been you know, pretty much trading in tandem with each other. That's the weekly review. Let's go down to the daily chart, and that didn't even carry over. Gee, like you're playing with my emotions. Matter of fact, that's one way of doing it. The other way of doing this is to do this visibility on current interval and above, current interval and below. That suffices there. So we go to the daily chart, and you got it. And these tan or peach colors, that they delineate a new week. So this would be Monday, Tuesday, Wednesday, Thursday, Friday. So Thursday, characteristic of Thursday is pretty much essentially like a reversal day. Didn't quite reverse, but you can see it's it closed as a bull bar, and you can still see somewhat. Let's see what we got. Let's see. So last week, running above this high, and we have this trading into here. This chart is boring. I'm gonna go to the 4-hour chart because that's where I would normally go. Like, why not, right? So weekly, 4-hour, and then 15-minute, right? ICT, weekly, daily, and then the 4-hour as the high time frame, as a short term or the trading time frame. In this case, the weekly chart was clear, so I didn't have to go to the daily chart, and I just went to straight to the 4-hour. So there was logic there. I wasn't just abandoning the time frame just because I could, right? Right. So here's your run on stops on the 4-hour chart, and again, we trading for a weekly setup, weekly range. Yeah, this run up here, it's nice too, right? I think we may have highlighted this already, but anyway, it's that. And we have here again. Anyway, so we have here run on external liquidity, retrace into an internal liquidity. Price is holding above the halfway mark or the consequent encroachment of this fair value gap. Push higher, another run on external liquidity, push higher, run on. So you have 1, 2, 3. Then you have a retracement down into optimal trade entry into this fair value gap, or order block. Price trades up, runs buy side again, the previous week's high, and it can't hold. You have this fair value gap here, right? That's the first one, right? You have this. That's the first one. You color that like a gray. So this would be your turtle soup or your smart money reversal. You can actually trade this into this bearish order block. It didn't quite trade into that, but you can use the wicks, right? Or a portion of it. Doesn't matter. My trade here would be the inverted fair value gap. Price drop below, pull back, open at the midpoint of it, and then dropped. That's a trade back into this bullish fair value gap. Price shot up, and then so close here, open here, ran up, dropped. Good money, good opportunity to go short there, right? So you have price. I'm sure if everything I'm saying is clear, but it is clear to me, and I'm just reviewing price action. So that's the low, swing low that was broken. It's also a breaker, a low, high, low, higher high. So this whole thing is a breaker. Let's say these 3 bars. You can count this one because you have a liquidity void in the middle. Let's count these 3. You know, whatever you're certain of, just do that, right? If you pull that over, because this was a bullish fair value gap and price stabbed through, trade it back into this imbalance that was formed here. And there's your short opportunity. More retracement into this order block. Dropped down into that weekly draw on liquidity, which was this volume imbalance. And then there's a small little fair value gap here. I use these parallel channels for these tiny ones because I'm not being a surgeon. All right, so BAM, there's that. That's a 4-hour chart. And these are let's just label this one, say, weekly time imbalance. All of these are 4 hours. Let's see, make sure that I'm into and below. Right. And all right, so that you can kind of go here, 1-hour chart if you fancied, if you wanted to look for setups here. This is a retracement, optimal trade entry long here in the 1 hour. Out of that, almost completed the market maker sell model here. Anyway, 15-minute, and we look for opportunities here based on the levels we have. We have our break in market structure, the previous week's high. Ran the intraday high. Yep. Dropped again. So we have a lot of opportunities here. Anyway, we kind of discussed these already, and this is today's opportunity. We didn't highlight the weekly draw on liquidity in the previous videos, but you can see here price did not hold. Previous day's low would have been the target here. Just label that previous day's low. Previous day's high, we don't need to mark it out, but that would be a key level. Likewise, this, what I highlighted before, this is Monday's low. And this is your break, retracement, break, drop, consolidate, break, traded right back into Monday's low, didn't hold and drop. Also traded into this 4-hour bearish fair value gap. Then you have this 4-hour bullish fair value gap that didn't hold, and we have this bearish fair value gap here. Let's get rid of the midpoint. It's getting kind of noisy. And you can see price did not hold. Bring forward. All right. So you see here that price didn't hold up above the midpoint of the inverted 4-hour fair value gap. This is during the London session, and you got a drop violating this as well, this bullish fair value gap. Use that, have that. And, right, and this kind of zoom in a little. It's this, and you can see the bodies are respecting this inverted fair value gap. All right, and then boom. A tiny little fair value gap that we highlighted here. 4-hour level. This is right. So the weekly draw was met. Then we have here, drop down. See a turtle soup. You could have used divide this into quarters. That's like surgery though. So this would be, for me, this would be your turtle soup. I wouldn't have taken this entry. You have the previous month's high as a key level as well. But this right here would have been, once price broke above that after reaching this high time frame draw on liquidity, then this run up higher, and then this candle dropping back down into this inverted fair value gap. That would be a key moment for an entry, right? So it was one thing it did was violate this bearish fair value gap, turn it into an inverted fair value gap, pulling back down into it. And it also essentially rebalanced this price range. So this would have been a fair value gap if this candle didn't open here, drop down, and then close here. And then after that, it proceeded to the upside, right? It didn't quite reach. It left a small gap here though, but yeah, that's pretty good. You have that run up, and then just being patient throughout the day. But this would have been your 945. So that was this grind up into this 4-hour fair value gap high time frame. Based on this current time frame, 15-minute, 4 hours is a high time frame chart. And then we have this 15-minute fair value gap here. I guess the question, I don't know what the question would be, but I'm going to assume anything. Boom, 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 boom. All right, so you see the wicks, the bodies is just bouncing around here. That's all good, right? So it failed here. And again, it's a 4-hour, small, tiny 4-hour fair value gap. This trade here on this time frame, filled with order blocks. You got a breaker here as well. You got a high, a low, and a higher high, so to speak. High, low, higher high. And that's based on the lower time frame. So let's go. You can see it there. It's here, right? So high, low, higher high. Drag that out. Anyway, so you have a fair value gap. Tiny fair value gap here, and you have another one here. What is continuation pattern into this 4-hour level? Well, that's 15-minute level. Let me see. It's a 15 more minute. And let's see, for the power hour, do we have a market maker buy or sell model? But I only highlight these 15 certain hour buy and sell models. Last hour is something that I look for. Also, let's check out 7 o'clock to 8:30. So I think they had this. See, we can use this. I used to use this before. Let's see if I. Nah, not that one. Not that one. It's this one, maybe. I would like to have seen it drop all the way down here though, but let's just do this. Right. All right, so this would be your 3, and this to make that thicker. Use that to like solid. Nope, that's all in the way. All right, that's better. Then we do 4 o'clock. And this is a 1-minute chart. And the reason why is because generally for me, I find my, look at all this, it's choppy, 15 minutes, you know? So 5 minutes, so we see accumulation, just accumulating here in this range. Then it broke the range, then it retraced. So that's another way of looking at it. Accumulation, technically this is manipulation here, manipulation leg here. This tiny fair value gap, if you wanted to use that, or that's just too granular. Here's the break and market structure. Here's your, so you have these 2 down close candles. That's significant. Or just use this fair value gap here. Pretty good, yeah. So it's an opportunity visible on the 5-minute chart. There's your break. Consolidate it. And we had this fair value gap here. Right, and here you go. But like it. I don't like it. This is the break. This is the most significant break here to me because of this imbalance here that's violated. So yeah, that's your opportunity into that 4-hour or 15-minute gap. Can you label these things? Yeah. 15 minute, 15 more minutes. All right, so it's an opportunity. All right, 5-minute. So that's actually, this is a 15-minute chart. Let's go back down to the 5. So we have that price holding this. Well, we have another bullish fair value gap here. We didn't like this one, so but that's a decent trade. I like the 1 minute here because you can see a sell model. It's clearer to me here. You have here run down. There's no breaking structure. There's no fair value gap form. Run up, ran the high again. 1, 2, 3 drives pattern into this imbalance, 4-hour imbalance. Then we have significant displacement, breaking market structure here, breaking structure here, significant. This break is significant because of this gap here that's been violated, and a retracement into this imbalance. Is your short. Is a return to origin. Right? You're short here at 236. Inverted fair value gap in here at 1435, and then price lower running these stops. Didn't. Now we have relative lows here. 3 o'clock hits, have a retracement back into this 1417, this 217 p.m. fair value gap that caused price to go lower here. That went down. That sent price lower, ran these relative lows, and we have a balanced price range here. Let's highlight the inverted fair value gap. Right, so we have that. Turn that like a darker color. Right, so there you go. Optimum trade entry short as well. Here's your entry, 78.6, and dropped. And as a principle, you don't have to use this long wick. For myself, that's up to you. And we have an entry here, also into this bearish fair value gap. If you didn't want to do the balance price, you didn't see the balance price range, you didn't see the inverted fair value gap, you created this one into here. Short opportunity at 341, 342. So that's also the 1515 to 1545 macro. Then the 1545 here, drop down, retrace, tiny little fair value gap on the 1545 candle, but also an inverted fair value gap on the 1538 candle. And then retrace here, break, pull back into this down close candle, mitigation block or breaker, and continue to drop, looking for this swing low, then this swing low, and then I would have been targeting this swing low. Right, so that's that. That's your market maker buy model here. I guess this would be the original consolidation. I would like this right here is preferable to me, but it did break out of this consolidation, retrace, so it was literally traded back into this consolidation, didn't break below it yet, at least. All right, so that's that. Let's see, go to 7 to 8:30, because also a market maker buy or sell model should be here as well. Yep, and that's visible here. That's when all the drama started. That's where all the bleeding started. Anyway, so we have a run on stops here. They didn't have a breaking structure, but you have a change in state of delivery because you have these two up close. You have these two bullish fair value gaps that were violated. Retrace into this first one here and consolidate it, and then dropped. So that's there. Inverted bullish fair value gap here. 5-minute chart. And let's go back to the 1 minute. Cute, it's cute though. Cute, man. All right, so we have the same situation going on here. Similar. All right, so you ran the Asia high. All right, so you ran the Asia low first, then ran the Asia high. Validated, came up, ran that high that broke the Asia high. Price stayed below this high time frame. Fair value gap, bearish fair value gap, breaking market structure, a retracement. Excuse me. Retracement. A retracement here. You got a small fair value gap here. Right. Dropped. Retrace into this fair value gap. Drop. Broke that. Retrace back up. And this bled out. Stopped here. Retrace. Consolidate it. Run on stops here. And then dropped. It's the optimal trade entry long here to here. This is the range that price is currently in on this 1 minute chart. And you got to think in terms of probability. In terms of probability, not in terms of absolutes. So you see the bodies. Price ran the stops. Optimal trade entry short. Or oof, nice. Huh? How many standard deviations is that? You eyeball it. Let's duplicate this a couple of times. I would say you got 5, about 6, about 7, 7.5, 7. How do you do? No, I have to be that specific, and you can just do 8. Right? So hit 8. So that was basing your entry to stop. So that's pretty decent entry to stop. Your risk to reward ratio, your percent R is great, and your multiples of R is great. And if you use standard deviations to measure that movement, then that's obviously great. So that's 8 standard deviations of the range itself. This from this high to this low, multiply 8 times will get you that. And that's outstanding. So this is also, again, your opportunity for 7 to 8:30 a.m. silver bullet model. And honestly, for me, for this 3 to 4, utilizing the macros in that time frame, and also the silver bullet for 7 to 8:30, 15-minute chart in the 1 minute is sufficient for me. So 15, 5, and 1. So whatever, if the 5 is clear, you don't need to come down here. But anyway, thanks for listening. I think I went hard and fast. I think it was more concrete, more potent than normal. I would like to think so. But anyway, please like, comment, subscribe, and I look forward to speaking to you soon. Deuces. Peace.